Hey everyone, welcome back. Let me ask you something. Have you ever felt like just when you finally get a handle on your retirement savings, the rules suddenly change on you? You've been working hard, saving year after year, and now, right as you're starting to think about how you'll actually use that money, new rules are being written that could shift your taxes and even what you're allowed to invest in. And the truth is, these changes aren't far off, they're already beginning. For some people, it could mean paying more than expected. For others, it could mean being offered choices they never thought they'd see in a retirement plan. The question is, are these changes helping you or setting you up for new risks? Stay with me, because what I'm about to share could make a big difference in how you protect the money you've worked your whole life to save. Before we go further, let me know in the comments, do you think retirement rules should stay steady so people can plan? Or is it better to keep adding new options, even if it gets more complicated? And if you find these updates helpful, hit subscribe so you don't miss the next one. So let's start with the bigger picture. Retirement accounts like 401ks have always been the backbone of American savings. You contribute during your working years, you get certain tax advantages, and then you rely on those funds in retirement. For decades, the rules have been fairly predictable. Pre-tax contributions lowered your taxable income. Growth inside the account was tax deferred, and then withdrawals in retirement were taxed as income. Simple enough, right? But here's where things get complicated. The ground rules are changing in ways that shift when you pay taxes and what you can actually invest in. One of the most important updates has to do with something called catch-up contributions. If you're 50 or older, you've probably heard about these. They let you add more money to your retirement account beyond the normal limits, giving you a chance to boost savings later in life. For years, these contributions could be made pre-tax, which was great for reducing taxable income today. But now, for higher earners, that's not going to be the case much longer. So here's what's happening. Starting in the next couple of years, if you make over $145,000, your catch-up contributions will have to go into a Roth account. That means instead of lowering your taxes today, you'll pay tax up front, and then you'll get tax-free withdrawals later on. At first glance, that might sound fine. Who doesn't like the idea of tax-free money later? But think about the timing. If you're at the peak of your earning years, this could push up your taxable income right when you can least afford it. Imagine being 60 years old, earning in a high bracket, and making an extra $11,000 in catch-up contributions. Under the old rules, that lowered your taxable income. Under the new rules, you'd owe thousands more in tax that year. And doesn't stop there. A higher income might knock you out of eligibility for other deductions or even bump you into a higher bracket. So while the promise of tax-free withdrawals later is nice, for some people this could sting in the short run. Now let's pause for a second. Why would the government make this change? Well, the answer is pretty straightforward: revenue. By collecting taxes now, instead of waiting decades for you to retire, they boost today's tax receipts. It's the first time the tax code has ever required Roth treatment, and it shows a clear shift in how policymakers view retirement savings. They're less focused on giving you a break today and more focused on securing tax revenue sooner. And here's a curveball. If your employer doesn't offer a Roth option in your plan, you won't be able to make catch-up contributions at all. That's a major problem for folks at smaller companies where plan options are limited. Most large employers do offer Roth accounts now, but not all. And if yours doesn't, you could lose the ability to save extra altogether. So what does this mean for you? If you're a high earner nearing retirement, you might want to start planning now. Talk to a financial advisor, figure out what the change will do to your tax bill, and see if there are strategies to offset the impact. Now, that's one half of the story. The other half is something people didn't really expect: crypto and other alternative investments making their way into 401k plans. Yes, you heard that right. A recent executive order has opened the door for things like Bitcoin, private equity, and even real estate to be offered in retirement accounts. The reasoning behind it is framed around fairness. The administration argues that pensions and big institutions already invest in these kinds of assets. So why should regular workers be left out? And to prove the point, look at the Michigan retirement system, which recently held tens of millions in Bitcoin and Ethereum ETFs. For them, it's just a sliver of a massive portfolio, but it shows that big money is already in the game. So then the question is, Should individuals be able to do the same? Supporters in Congress say yes. It's about giving people more choice and more opportunity. Critics say no. It's exposing workers to unnecessary risk. And honestly, both sides have a point. On one hand, crypto and alternatives could add growth potential. If you're younger, say in your 30s or 40s, putting a small piece of your portfolio into something like Bitcoin might be a risk you're comfortable taking. You'd have decades to ride out the volatility. On the other hand, if you're in your 60s and looking to retire soon, the thought of a huge crash wiping out a portion of your savings isn't something you can brush off. Bitcoin once lost over 80% of its value in a single year, and that could be devastating if you needed the money right then. And also, it's not just about risk, it's about cost and complexity. Some experts warn that private equity or crypto options offered to 401k plans might come with high fees or less than stellar investment choices. In other words, you might not be getting the same quality that institutions have access to. But let's not ignore the enthusiasm. For a lot of people, this is exciting. Advocates argue it reflects what savers already want, since millions already hold crypto outside their retirement accounts. Some people see this as a way to bring crypto into the mainstream. And groups like Stand with Crypto say this is about modernizing retirement savings for the digital age. So, how do you put this all together? On one side, the government is saying we need more tax revenue now, so higher earners will pay sooner through Roth contributions. On the other side, they're saying we're giving you more freedom in what you can invest in, even if it comes with risk. That combination shifts responsibility onto you. You'll have to decide how much tax you're willing to pay now and how much risk you're willing to take on with your future. And that's really the theme here. Retirement used to be about stability and predictability. Save consistently, defer taxes, then draw down slowly in retirement. Now it's about personalization, choice, and yes, more complexity. You're being asked to make tougher calls, when to pay tax, what to invest in, and how much risk to carry. So what should you do with all this? Start by checking whether your employer offers a Roth option. If not, push for it, because otherwise you might lose out on catch-up contributions. Then, run the math on your own taxes. See how much more you might owe under the new rules and plan accordingly. Finally, if your plan starts offering crypto or other alternatives, take a step back and ask, does this fit my risk tolerance and my timeline? For some, a small slice might make sense. For others, sticking with traditional options could be the safer move. You see, at the end of the day, there's no one-size-fits-all answer. Some people will embrace these changes as opportunities, others will see them as challenges. But either way, they're coming, and being informed now gives you a chance to adapt before it catches you off guard. And speaking of choices, let me know in the comments, would you consider putting a portion of your retirement money into something like Bitcoin, or would you rather keep it in more traditional investments? I'm curious to see where you stand. And don't forget to hit subscribe for more updates like this. Thanks for being here, take care, and I'll see you next time.